With that, I will turn it over to you, Karen.
Thank you, Jeffrey. Well, tonight I was thinking about something my dad always said, and that was, you can't get away from death and taxes. Well, tonight we're going to look at whether that's really true. Because, sure, we're all going to pass away one day, but we don't have to pay the same amount of taxes as if we throw up our hands and say, oh, well, let's just pay our taxes. So tonight we're going to look at how does our tax system work when you do die, and what are the opportunities that you can take advantage of to consider donating. And you don't have to be a multimillionaire to use a number of these strategies if you want to help reduce your taxes in lieu of just paying them to the government. So the first thing I'm going to start with is just some background information so that you understand what happens when you do pass away. You'll have to have someone take over your estate, an executor, and they'll file a final tax return for you. And on that final return will be the income you earned from January 1st of that year to the date you pass away. And then there's always two potential special items of income on that return. The first is a deemed, i.e., a pretend sale, if you will, of all of your capital properties. That's Canadian or even offshore foreign properties at their fair market value immediately before you pass away. So what's a capital property? That could be some stock you own, or bonds, or real estate, private company shares, jewelry, art. Any of those items are deemed sold at the point that you pass away. A principal residence exemption is there to shelter tax on your house, your home, or your condo, but everything else could trigger a lot of tax. And the other one that's special is that there's a deemed collapse of your RSP and RIF. And the full value of those items, whichever one you have, comes into income. Oh, and so I missed one little point here. When you've got that deemed sale of all your capital property, not all of it's taxed. I mean, the difference between the value less the cost is potentially a gain or loss. And if it's a gain, 50% is taxable or includable in your income. So that's the worst case if you don't have a spouse or common law partner that you're leaving your property to. And there's one other exception, but it's hardly ever used. That's if you're transferring property to a disabled minor dependent and it's held in trust for them. So a lot of people pay a lot of tax when they pass away. Now, as I've often said to a number of my clients, when you pass away, how did you envision leaving your assets when you die? I mean, actually, I had this conversation with one of my clients just last week, and she piped up and said, well, I don't have a husband. I never married. I don't have children, but I have two siblings that are still with me and one that passed away earlier. So I'll leave it to the child of that sibling. So that's three ways. I want it to go three ways. And I said to her, you're missing one beneficiary. And she looked at me rather surprised, like, what was I talking about? I said, guess what? The CRA is also a beneficiary, and the CRA is going to be coming on in and taking taking a piece of the action before it even goes to your siblings or your siblings and your niece. You have four beneficiaries. And she was shocked. She'd never thought of it that way before. So I said to her, what do you want to do? Do you want to just passively hand over that kind of money? Or do you want to consider some charitable donations in your will? Because anything that's gifted to charity will generate a tax receipt. And that receipt means an amount that can be claimed to reduce the net income on that final tax return. And the value is anywhere between 40% of the donated amount to 50%, depending on how wealthy the person is. So it's a pretty powerful deduction. Until your estate's wound up, there's also an estate after your death. And then during that period, all of your properties are collected, your debts are paid off, taxes are paid off, legacies are paid out. That means, amounts you've specified specifically in your will to go to somebody or to a charity until you get down to what's called the residue. And that's distributed outright to beneficiaries or it's paid into trusts. And we're going to talk about trusts a little later on. Income gets reported on a separate tax return for the estate. And you get to, here's some little magic in that year. You actually get to pick any 12-month period and get better tax rates in that estate for the first 3 years. Well, any donations we can't use at the time of death can still be used on the estate returns for up to 5 years. So I've had clients who may want to leave a bigger gift, like an RSP or RIF, and they're worried, what if it wipes out all the taxes on my final return, but I have excess, which does happen sometimes. Not to worry, we actually can get benefit of sheltering income and taxes into the estate. So, to appreciate what happens when you are structuring your will with your lawyer and your advisors like me, there are different types of gifts. I mean, we have legacy gifts. That's where you specifically say, I direct a gift of, and let's say it's $5,000 to a particular charity like Asthma Canada. And that's to say, the key parts are it's naming a specific amount typically, and it's often done by cash, but doesn't have to be, and you name the charity. There are variations. You can do other things, but we'll keep it simple here tonight. The other one is a gift of the residue, as I say, and the residue was what remains after all the money's collected, after all the bills have been paid, all the taxes otherwise there get paid, what's left. And if you say something like, I leave 20% of the residue of my estate to Asthma Canada, then an accountant will have to calculate what is the value of your estate and what is the 20%. But that potentially is a much bigger gift. And finally, there are some alternative gifts that you can make. And that would be typically like an RSP or a RIF, a TFSA. Some people have life insurance. Those are other products that don't typically go through your estate. You set them up where you designate an RSP or you designate life insurance. It passes over the estate to miss probate, and they can still generate tax deductions. And we're going to come back to that because I'm going to go through how they work as well. Take a pause here. So yes, let's start with RSPs and RIFs because I want you to think beyond cash. Everybody starts with, oh, I got to make a gift of cash. Well, for a lot of people, the biggest asset they hold, other than their house, at the time of death, is an RSP or RIF. And as I say, the house will have a principal residence exemption, but the RIF or RSP, whoosh, a whole lot of tax could come right off the top. And I've seen a lot where 50% of the value is lost in taxes. However, if you designate say a charity like Asthma Canada, or other charities you want to benefit for the full or a partial amount of that RIF, then that money will be paid out to the charity and it will give you a credit of 40 to 50% of the donated amount, depending on your net income, again, as I said. So funds that would otherwise just go straight off the top to taxes are redirected towards a cause that you would prefer. And it helps to work with an accountant who could crunch some numbers for you and see the results of different scenarios and different levels of donations and designations. The couple of the benefits of doing a designation of the RSP or RIF is that during your lifetime, you can change your plans on the designation. So if you decide that you, for whatever reason, don't want it to be one charity and you want it to go to another, that's still something you can change. If you don't want it to go there at all, you can change it. Your designation is what we call revocable and can be changed. But most people, once they decide to go down this route, they don't make a change in what they're doing. How do you do it? Do speak with your financial advisor. So if you have your RIF mostly at RBC, for example, yeah, go to RBC, talk to the people managing your RSP RIF, and get them to change on the contract who the RSP beneficiary will be. If the other way you want to do it is potentially through a will, I don't see this one as often, but it can be done. That it takes a little bit of crafting to make sure the funds will not be subject to probate fees, but a good lawyer can put the right wording in to make sure the RSP RIF comes to the executor in their capacity as a trustee, and then does the rest of the will as always. A little bit of magic there, but it's what has to be done to get it done right. Oh, I think we got a double here. Okay. Now, here's an opportunity a lot of people are missing. And if you are thinking of making larger gifts, and here I'm not talking anything less than $5,000. I think below $5,000, and it's not worth the effort or the costs or things that are involved. People often say that, I mean, a lot of times, like, what is the cutoff amount? But that's what I think is reasonable. Instead of just giving cash, or especially don't do it where you cash out a stock and donate the net money. What you can do is do a transfer of the stock directly from your investment portfolio to Asthma Canada's investment portfolio. And you do it in a way that that donation, sorry, I've got a dry mouth here tonight. The value of that donation will be the value that the stock gets cashed out in the hands of the recipient. So if there's a gift of stock made today, we look at typically it's transferred over tomorrow, what does it get cashed out for? That's the tax receipt that Asthma Canada can give you. And with the stock that you transferred, you get two benefits. One, you don't pay any capital gains tax on the stock that was cashed, unlike if you did something yourself. So it's an opportunity to pick a stock that has the biggest capital gain you probably have and just donate that one and eliminate that capital gain from being in your portfolio. And second, the value of that stock is going to give you a charitable tax receipt that you can use on your tax return in the year of the gift, or up to 5 subsequent years if you're a donor who's alive. And if it's the estate, he'll be in the estate, even an estate can do this, in the year the estate makes a gift. So it's an excellent way to make a larger gift rather than doing it with cash, and benefit both from the elimination of the gain and the value of the receipt. With Asthma Canada, the process is to contact your financial advisor and tell them you wish to make a donation, and then work it out with them about which stock makes the most sense to give to you. There's always a form to download specific to each charity called a security transfer form, and we've give you sort of a located address here for it. And it's not complicated, just has specific information about you and the stock you're transferring, and it's CUSIP number and yada, 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 all those details. And then, of course, Asthma understands to expect the stock and to watch for it and to give you the receipt for the amount once it's cleared their account. So it sounds worse than it is. It's actually a very, very simple process. And the brokers now have been doing it for many years. So Once you tell your broker this is what you want to do, they pick up and handle almost 99.9% of the work. Pause here. Here's another interesting way to consider a gift. And I know a number of people that hit a certain stage of their life, and maybe they've got a life insurance policy that they're not feeling that they need anymore. I mean, you often get life insurance maybe when you're trying to fund a particular problem like tax on death related to a business. But what if the business gets sold? That happened to one of my clients. Or maybe it's, insurance for in case you pass away while your children are young, but your children are grown up. So there are times when people have a life insurance policy, and we look at the question of do we just let it lapse, or could we do something with it beneficial with a charity? So one of the options is to give that policy to a charity like Asthma and pay the ongoing premiums. Asthma would become now the owner of the policy, but there's still ongoing premiums. If it's no longer needed by you, Asthma will give you a receipt equal to the fair market value of that policy. So you have to look at the type of insurance. Is it a whole life policy that has a value, or is it just a term insurance policy that may or may not have value? So an actuary gets brought in by the insurance company, working with, say, your insurance agent, to look at the policy and determine whether it's possible to have the charity issue a donation receipt. On this type scenario, after you've gifted it to the charity, the beneficiary of that policy gets changed to the charity, and the donor has to commit to paying the premiums during their lifetime. And as they do, they will receive ongoing donation receipts equal to those payments. The one challenge with this, to be frank, is that it puts a bit of risk on the charities of how they can be sure you'll pay the policy premiums. So, well, it's possible. I'm less sure how practical it is for everyone to get into that type of arrangement with a charity. What you see more of is, oops, I'm just going to move forward on this one. The second way is that you continue to hold the life insurance during your lifetime, and you name the charity as the beneficiary of that policy. And at that type of scenario, then there's no receipts, no tax receipts given during your lifetime because you're still holding the insurance and making the premium payments, but at any time you could change the beneficiary of that policy. However, for your estate, you pass away and the charity, like Asthma Canada, receives the entire death benefit from the insurance. In a pretty large charitable tax receipt can be issued now by the charity to your estate. So this is a way that you can, pay the premiums during your lifetime and make a very large gift typically at the time your estate, by your estate at the time you pass away. You might be surprised as to what it would cost to set up one of these policies, and even with the premiums for a while, and to get the charitable deduction later on. I wanted to add a little piece in here about trust because we got some questions last time at the last seminar about what a trust is and what it's about and how we can use it. Trusts are an interesting animal, as they call it, because trusts are not like a corporation and they're not like a partnership. It's actually not a legal entity. It's a relationship. And even though under the Tax Act, they make a trust file a tax return, under common law, it is not a legal entity. As I say, it's a relationship between, and it splits up the legal owner of the property, who's got title, that's your trustees, and the true beneficial owners belonging to that property. So, as a quick example, like it's a split where somebody has legal title to manage money, say a bank account, but the bank account's not theirs. The bank account belongs to whomever has been named as the beneficial owners. And ultimately, they're the ones that are going to get that property. So I see it the most when we have minor children's under a will, children under a will. And of course, you don't want an untimely death to place large sums of money into a child's hands. So until they are older, any money that was, say, passing unexpectedly to a young child will go into a trust. And people that are trustees, they could be family members, they could be friends, they could be actually a trust company, a bank. They're charged with being the trustees, and they have, quote, a fiduciary duty to hold that property, manage that property, but it's not theirs. And the child, on the other hand, they don't get the property yet. They don't get the money until they're older. But in the meantime, it is theirs, and it's being managed on their behalf. So we use that concept with some different special trusts that help typically in a number of different special cases. Disabled beneficiaries have a trust that came on the scene in 2016 called a Qualifying Disability Trust. It can be set up to hold property for disabled beneficiaries only. I mean, the beneficiary must have been certified as disabled by a doctor and a disability form filed with CRA, filed and approved. And we call them QDTs. They enjoy what we call graduated tax rates, meaning each level of income goes through the lowest bracket, a middle bracket, a higher bracket. Not all the money is subject to tax at high rates. And the management of the property can last for many, many years. So the qualifying disability trusts are often set up as a way to help disabled beneficiaries. Another common trust in estate planning may be spousal trusts. And spousal trusts can be put in place for many reasons, but I see them a lot in blended families. So here's an example. Husband has divorced. Husband and wife have divorced. They have 3 kids. Husband remarries. He wants to support his new wife if he should die, but ultimately he wants his assets to go to his children from the first marriage. So a spousal trust lets him defer tax on his death, and the assets he's holding at that point pour over into this trust without income tax. And then when the new wife passes away, that's when the income tax is triggered. The other one I sort of wanted to touch on here with it is the charitable remainder trusts, which not enough people actually know about. They're unique ways to use a trust related to a charity. They call them CRTs. CRT can be set up actually during your lifetime or in a will on death. Once it's set up, it's not revocable. That's one thing to remember. So a typical scenario is a donor transfers assets like cash, publicly traded securities, maybe rental real estate, to a trustee. And that trustee is someone typically pretty formal, like a trust company. This donor, or even a designated person like a child, receives income from that trust for life. Or maybe they set it up for 10 years. And then once that period ends, the remaining assets go on to the charity. Well, here's one of the benefits. There can be an immediate tax receipt for the present value of the future gift. And that's determined by looking at what do you expect to be the future gift. So you need an actuary again to determine what's the current market value of the assets, what's your age, what's your health, what are the interest rates right now, to work out what they think the future gift will be. The nice part about these trusts is that there's no probate when you pass away. They're private, and you keep income assets in your, still receiving income from these assets for a period of time. I just wanted to add two more slides here quickly. Corporate donations. We don't want to forget that corporations can also make donations, but in this case, the donations are deductible. They don't generate credits like an individual gets. They're actually deductible in determining the income and therefore the tax the corporation pays. So the tax saved can be a little more than 50% if it's an investment company, i.e. a company holding stocks and bonds and generating capital gains, or if it's a company that's in business of carrying on a business, we call them an active business, 26.5% if they're earning income over $500,000, or 12.2% on income below $500,000. So it's a little different here for a company. And then on the other hand, to compare, an individual receives a non-refundable credit, meaning that if you don't have tax, you will not benefit from the credit unless you pool them up, you will not benefit from the credits. The first $200, you get a 20.05% credit against your taxes. If it's more than that, it's going to be a 40.1% credit, or as much as 50% credit, depending on how high your income is. And stock donations, insurance donations are done by corporations. The last thing I want to warn you against is a few years back, this was running rampant. People were taking advantage of donations to charities that were under these various tax shelter schemes. And what does that mean? It meant the donor was really given a false receipt. They hardly donated anything, and yet the receipts they got were hugely inflated, as if the donated property had an excessive value. So a lot of that has been shut down. CRA has audited them pretty hard. So be careful of that. If something seems too good to be true, you want to back off. And finally, there's another rule that if you acquired something and donated it within 3 years of the acquisition, there is a rule that can roll back the value of your receipt. And so we look at that to be careful as well. The only one is that you don't have to worry about the 3-year rule with stock donations. And at this point, thank you very much. My takeaways. Developing a philanthropic tax and estate plan helps to benefit causes that mean the most to you and your family, but also makes quite a dent in your taxes, both either current or on your death. There's a whole lot, as you've seen, favorable tax rules to benefit donors and their companies and to encourage smart charitable giving. Don't just think about cash. Your RSPs, your RIF, marketable securities, life insurance, real estate. There's lots of options out there and lots of different tax results because of those gifts. So it's worth having a good discussion with a financial advisor, accountant, and so on to just see what makes the most sense for your situation. Think about gifts during your lifetime or whether it makes more sense to do it after death through your will. And finally, yeah, watch out for those schemes. If it sounds too good, just stay away. You can bounce it off somebody, but they're usually worse to do. All right, I'm going to now turn it over to Jeffrey.
Thanks very much, Karen. That was fantastic. Your knowledge is vast, and you present things in a way that makes it easy for the non-finance and accounting and legal minds that are like myself who are trying to digest this information. So thank you very much for that. I realized as well, if you were with us at the beginning of the session, I didn't introduce myself. So my name is Jeff Beach, and I'm the President and CEO of Asthma Canada. We're very pleased to provide this webinar to you, to the community. Keep in mind the fact that by including Asthma Canada as a beneficiary in your will, you're ensuring that a portion of or all of your estate will continue to build a legacy and have an impact for you beyond your lifetime. And that's in support of asthma education, advocacy, and research programs that we offer. We recognize that the information that's being presented here is applicable to you, regardless of whether you're considering supporting Asthma Canada or any other charity. But I do want to highlight the fact that the charities that are receiving these benefits, Karen's talked a lot about the benefits to you and to your estate and your beneficiaries, but these gifts are huge for us as charities. And oftentimes people are able to give larger gifts through their estates than they might be able to when they're alive. So we thank you for keeping that in mind. We are going to move into a Q&A session in a moment, but I think there's one more slide. Karen, if you can just move that ahead before we go into Q&A, just a few important reminders. First of all, you're never too young to have a will. This is something, as I said at the beginning, that oftentimes people don't necessarily want to think about, but it is something that all of us need to consider and have an action plan around. Your estate plan is also not static, so it's important to review it every few years. Things change, life situations change, and financial situations change. So it's really important to not create a will, file it away, and then forget about it. It's something that has to be reviewed from time to time. And as you take time to reflect on your will, you have to consider things like what matters most to you. So when you're talking about if you have a family, your community, charitable causes that you care about, for some people, maybe religious causes, their church and that sort of thing. And what do you hope to leave behind? What do you want your legacy to be? Because charitable bequests have created amazing legacies for charities. We have a couple of our research funds that live today because of charitable bequests that are still, the donors still having impact on asthma research and support that we provide. So keep those things in mind. And I think with that, we're going to go into Q&A for tonight. So if you have any questions that you'd like to put into the chat, or rather the Q&A feature, if you move your cursor, sorry, I'm struggling for that word, along the bottom of your screen, you will see a Q&A button. If you click on that, it pops up. It's really easy to put a question in there, and we'll try to get to as many as we can. We did receive quite a few questions in advance as well. So we'll start with one that I think, we just talked about the fact that wills need to be and estate plans need to be updated from time to time. So if a beneficiary is listed under a maiden name and then that name does that name need to be changed in a will? So those kind of details, is that something that can really create problems if it's not updated from time to time? And is that one of the reasons why estate plans and wills should be reviewed more frequently?
Thanks, Jeffrey. It's more of a legal question. I would typically refer that one to a lawyer, but it seems more logical to me that it should not be a problem because this happens quite frequently that wills, may not have a change from someone's maiden name to their married name. So I would have expected that if they can present their marriage documents related to that, the marriage certificate, I would suspect it's okay, but I would check with the lawyer on this one.
Yeah. Okay, perfect. So someone is asking as well, what is the most efficient method to leave the bank account, RSP, and TFSA assets to your family? And I think you covered a lot of that tonight, but maybe just present, if you will, talk about that the information that you maybe presented earlier, specific to the most efficient method. What's the most straightforward way to do this?
Yeah. Again, I would want to at least frame it in terms of what is the objective? Are we doing it as a way that's just how do we quickly transfer these to a family? TFSA, designate the TFSAs, bank accounts. It's always an interesting question. Do you make the account a joint with a family member like a child or not? That comes with its own pros and cons. Yes, it'll say probate, but consider, I've seen the worst play out where the child then scoops money out of the parent's account, sad to say. So there's a bit of pros and cons that simple isn't necessarily the best idea. And the last one was RSP?
TFSA.
TFSA. Yeah. So I think we covered that one. So
Yeah.
TFSA, again, I have no problem with that one. There's no tax implications, and then just decide if it's multiple children, one child, or so on.
Okay. Thank you. There are a couple of questions actually that have come in around assets that are real estate related. So one of the questions is, if I sell my house to my son before I pass away and rent to him, will his taxes increase or stay the same as what I'm paying?
Okay, it's one I need a little help, so I'm going to just factor into this one a little bit. Uh, if you're selling to your son, then why are you renting? I mean, it would then be your son's property, and he wouldn't need to pay you rent. So it's more in my mind is like, is there a benefit to renting to your son or not? But I'm going to change the question around a little bit because I often get the question of, should I transfer this property to my son today? And they may or may not pay rent. And I'll say, well, okay, you make the transfer, you're going to claim your principal residence exemption in most cases. So, okay, we aren't going to trigger tax. And then it's their property. And they can go forward from that point as their principal residence. Not necessarily a bad plan, but yeah, how do you go back and getting money for the rent? I'm sure this person's trying to find a way to have it, but give it up and still have it. That part, I'm a little confused by the plan. I'll be honest.
One of the questions that came in as well was about, you talked about the fact that that a lot of these tactics around donating assets to a charity, a portion of one's estate or a specific bequest, a certain amount, helps to prevent undue taxes, let's say, being paid upon someone's death. So one of the questions is related to this and asking, does adding a charitable gift in your will always reduce what family members will inherit? So does it have a detrimental effect in terms of what the family members might inherit, or can it sometimes actually increase the net amount that they would receive?
Is a great question, this one. Yep, to be honest, I mean, when you make a donation, cash or assets or something is leaving the estate. So that you're right in that aspect. Whoever asked this, there is a reduction in the assets that are going out, but it is balanced to some extent by the tax savings. At the end of the day, you want to make the charitable gift with the intention Jeffrey said, that you want to benefit whichever particular cause or causes. Okay, so I mean, Jeffrey expressed that even better than I was trying to do. Sometimes you are putting out $2 to save one. But if I'm happy doing it, if I get the benefit that yes, I wanted to help, let's say Asthma Canada, and at the same time, sure, I took a ding out of the stuff the CRA is going to get. But you're right, you're never going to typically get a point where there isn't some reduction in the estate assets for doing this.
Yeah. Okay, thank you. And I think that goes back to what you've said many times, in that you have to consider what are your objectives, what's most important to you, and if
Yeah.
supporting causes that mean something to you is important, then that is absolutely something that should be taken into consideration, and it does have a tax benefit at the end of the day. You talked quite a bit about donating securities, stocks, mutual funds, those types of assets uh, to charities. And are there specific rules about what qualifies in that realm, or could any stocks or mutual funds be donated to a charity?
Thanks, Jeff. They have to be publicly traded. So that's a key one, like listed on a public stock exchange. So stocks will work, bonds will work, ETFs, mutual funds, all of them that are publicly traded are fine. The ones that would have a problem is if someone's trying to do this with their private company shares. There's a whole set of other rules that come into play. But if we've got all of the typical investments there that are publicly traded, we'll be fine.
Thank you.
And the key is it just has to trade on a public stock exchange. So in theory, you could even go for US stock exchange, except I've never seen a charity accept a foreign stock. But in theory, they could. Yeah.
Okay, thank you for clarifying that. Another question that's just come in live a few minutes ago. How often should a will be updated?
My rule of thumb is at least every 5 years, but you also want to consider the key changes going on in your life. So if you had no children before and you now have a child, it's important to get it updated so you've got a guardian in there. If you've had a death in the family, you don't have a spouse anymore, you're going to relook at how your gifts are. They're no longer going to say to my spouse, how would you like those redistributed? So all the typical things in life, as in, yeah, there's been a birth, there's been a death, there's been a change in your financial circumstances. Maybe you got a big inheritance. Maybe there's a financial concern with a particular child. God forbid, maybe someone has a disability, one of your children. So anything that's happening like that that's significant is certainly driving, why don't we get the will updated? See a lawyer. But minimum, your life's good, all's going along. 5 years, 5 to 7 years is a rule of thumb to get it in there, but typically 5.
Yeah, that's it's good to keep that in mind because I think in my experience in dealing with bequest gifts over a number of years with different organizations, oftentimes wills haven't been touched in years. And so
Mm.
that sometimes creates problems because those life circumstances have changed. They've happened, but the will was written at a different time. So I think that's a great rule of thumb to consider minimum every 5 years or so. But obviously, if there's a life event or some circumstance that's changed, like having a child and so forth, that's great
I'm,
advice.
I'm going to throw one more out even. We went through a significant rewrite on some of the income tax rules related to spousal trusts in general, this whole graduated tax rate rules and so on. I had to revamp my own wills. There were big changes there that affected my own wills.
Yeah,
And it had been not that long since I had done the wills. So, the shoemaker in her own shoes, I had to get off my duff and get it done.
right. Yeah, well, and that just goes to show you it's not just your life events or the person holding the will, but CRA can create some of those reasons to update your will as well. So it's good to stay on top of that. Good to talk to your advisors
Yeah.
in terms of what makes sense for you. Uh, a question here is there's a live question that just came in, and that is, can you walk us through the steps needed to put an asset into a trust?
Okay. Um, there are some differences based on the type of trust. I presented a few, but there's actually quite a lot out there. Let's just pick one that's simpler. If it was that one for disabled beneficiaries, it's typically set up in your will. So you will say, this portion of my estate is to be held in trust. It's all set up really in the words of the will, is to be held in trust for my child Charlie during his lifetime. And these are the people that are manage that trust. These are it's for Charlie. Here's how he's to receive income each year. Here's if he ever needs more than the income to be paid out to him, how that's to happen. And a lot of it's all in there. And some of it's kind of boilerplate, as to what's supposed to happen to make sure it's on the side of the tax rules. Some of the other ones, I mean, literally it's changing an account that the spousal ones, it's on husband's name, but then we're going to put it into the name of the wife spousal trust. And it's just changing the name on the account and who's going to manage it. But a lot of them is actually done in a will. And if it's during your lifetime, it's done with a different document. We call it trust indenture. Trust indenture.
How much of the tax rules change from province to province? Is there a huge difference depending on what province you live in, or are certain things basically standard across the country?
Yeah, state rules are different province to territory. Different rules, different probate rates. different court cases in this area that affect cases and estate law as well. So it's not all the same. There is of course a smattering of stuff because of the federal tax rules and the tax act, but there is a variation because of each province's tax rules and legal rules.
Okay.
I have to remember that when I'm giving a talk to people across country and like this a little bit, that
Yeah.
what's happening here is not necessarily this absolutely the same in Calgary. So that's why everybody's listening. That's why the disclaimer, you got to make sure this is right for you.
Yeah. Yeah. And also the other disclaimer is, seek advice, seek professional advice when you're setting up your estate plans. Sort of along those lines, I guess, too, is person had asked if it would be okay for a notary to put together a will with a client, or is that not advisable?
In Quebec, that's what they want. They want a notary to be the one doing it. In Ontario, you need a lawyer, is my understanding. You can't do it with a notary. And I don't know the other provinces. So I'll claim ignorance on those ones, but I don't think you can do it with a notary here. So,
So again, best to check
yeah.
with your advisors on that. We had a question from someone who was asking in this scenario, she has a daughter who's a non-resident Canadian living abroad. She will own this, I'm quoting here, she will own my condo after I die. I need advice as to the best way for her to own the condo without having to pay too much taxes.
Um, that is a harder one to answer. There's a lot there because I don't know if it's going to continue on owning that, renting that, keeping it, or selling it after death. But do remember at the time this person passes away, there'll be that deemed sale of the property, which I don't know if it's not being rented or so on, it's her principal residence. That's no big deal. All it's done is move the value of the property and the cost up to the same thing, right?
Yeah.
It's worth in theory 700,000 right now. That'll be the new cost. And then if her daughter's going to continue with that, that's what she's going to inherit, $700,000. And it depends what she does with it. If she sells it, she's got to pay the tax on any incremental gain. So that one really does need a better consultation where someone goes through all the facts.
Yeah, sure. Okay, I've got one more question I'm going to ask, and if anyone has any additional questions, we do have a little bit more time if you want to drop them in. But this one, and again, I'm quoting, I am a divorced lady. I have two adult children and grandchildren. To avoid her children paying a lot of taxes, could I divide my estate to my grandkids and charities in different percentages? So talking about how much of the estate's being allocated to beneficiaries from the family and to charities.
Great question too. You have free reign to decide whether you want to jump over your children to go down to the level of your grandchildren or grandchildren mixed in with children or mixing in charities in there. The only part you gotta watch is if you are leaving a part in the name of a grandchild, it's gonna have to be held in trust. They're minors. They're not ready to own property. So somebody has to step in to look after that portion for that child. And if you don't name a child, the government can step in. And you don't want the children's lawyer, they're called, stepping in to manage it. And if, you're going to have a good lawyer who's going to talk about that just leaving something out there, even if you said hold it in trust, they're going to hold it in trust till they're 18. And then how big a share is this?
Right.
So the minor part does need some additional proper advice.
Yeah. Some really good questions. Very thought-provoking presentation. Karen, I want to thank you again on behalf of all of us who are benefiting from this information, especially on behalf of Asthma Canada, for donating your time and expertise to us and our community that's joining us.